The interesting news from you guys this week was that you are placing some pretty good-sized bets with some pretty big-name investors. You've got $100 million initial investment in Bridgewater, Ray Dalio, $100 million initial investment with Oaktree, an additional $90 million with Dan Loeb's Third Point Ultra Fund. And when you say initial, I mean, this is the first time that you've had exposure with Dalio and Oaktree?
Yeah, with Ray, yes. With Ray and with Howard Marks, yes. Dan Loeb, we've been an investor there many years. We sort of switched into his juicier fund, Third Point Ultra, added money there. What wasn't reported, which I can now report, we're putting $250 million with Steve Cohen at Point 72, who is one of my closest friends in the industry and obviously one of the more legendary investors. And I think he has the temperament and the skill set and the unbelievable team around him to do well in a post-COVID-19 environment. And so we had to make a tactical decision after March of directionally where we were going at SkyBridge. And so I still love structured credit. Last time I was on the show, we talked about it and the intrinsic value there. But I wanted to look at where markets are in a sort of pre-vaccine economy, Scott, and a post-vaccine economy. And so we need some nimble people. We need players like Ray Dalio that really understand the money supply and the quantitative easing cycle that the Fed is embarking on right now. And listen, we've been doing this together for 15 years, our investment management team. I've got a tremendous amount of confidence in our team. And I think it's the right thing to do right now at this point in the marketplace. And what I love about this story, I really just picked up the phone and called on several of our friends in the industry and said, we could use your help right now. And I'm thrilled to be partners with those guys. Just 1 second on Vegas. I think this is important what Pete was saying. You know, and I know after the 2008 crisis, Vegas was a dead zone. It feels that way right now. But when it comes back to life, it'll already be too late. And so one thing, Josh Friedman at Canyon made a big investment there. He owns a lot of high-yield bonds in gaming. It's an interesting way to play the recovery in gaming because you get a little bit of a defense a little higher up on the capital stack in bonds versus equities.
You mentioned March for you was rough. How did April shape up? How do things look now?
So what we did in April is we sold some of our LP interests and a few of our larger names to reposition the portfolio. And so like a company that's going through a restructuring, we sort of took a little bit of a charge in April. So we're only up about 70 basis points in April. We're having a pretty good May, but I wanted to take the hit, if you will, that one-time charge to get the portfolio positioned into these legendary investors. I wanted to get slots in there. You mentioned these are starting balances. We've got a lot of great clients, and I want to thank our clients for their loyalty. We have people adding. They added in May. They added in April. We expect a lot of money to come in on June 1st. And I want to be able to add to the capacity in the slots that we got in those larger managers. But no, April was a strategic shift for SkyBridge, and a result of which we took a little bit of a charge there to prepare ourselves for the next 12 to 18 months. I encourage people not to think about this stuff so short term. There's an adage my old boss had, Bob Castrignano at Goldman. He said, everybody is a long-term investor until they have short-term losses. And then once they get the short-term losses, Scott, they set their hair on fire and they run around in a circle. Let's not do that this time. There's a huge opportunity on the other side of this. There's tremendous amounts of stimulus coming in. The economy will normalize. And when it does, we're going to be back to very good growth rates and, back to GDP prints that look like the fourth quarter of 2019.
What do you make, though, of the here and now? And since we're talking about such legendary names in the investment community, we've heard from some this week and on this very program, whether it was David Tepper talking about the second most overvalued stock market that he's seen. Nelson Peltz yesterday, maybe you want to say on the other side of that, saying he still sees tremendous value, too much focus on tech driving the market higher. He's put new positions on, and then Stan Druckenmiller saying worst risk reward maybe in his whole career. So you've heard from them. You're putting money with the likes of the people you said. Where are we now?
Well, I had to rewind the Tepper thing. I was listening very carefully. I think he's obviously one of the smartest investors out there. I would tell you that they might be right in the stock market near term. Last time I was on the show, I said to you the market is ahead of itself in terms of anticipating more and more liquidity from the Fed. The bond market has clearly lagged. If you look at the investors that SkyBridge has added to, we've got nimble investors, multi-strat investors, guys that understand the quantitative easing cycle like Bridgewater, Howard Marks, one of the legendary distressed investors, Josh Friedman. We think the distress cycle is going to be terrific. And so, David may be right on the stock market in the near term, but I think longer term, as these things work out, we're in the right type of managers that have great versatility. I can't think of a better equity trader, as an example, than Steve Cohen in my lifetime. And so for me, I'm willing to place those bets, allow those great legendary managers to make those decisions. And I also recognize those managers have great relationships with their banks and their lending facilities. And it's, for me, it's very exciting for us to give our limited partners access to these names. And I think you got to look to the future, Scott, in terms of where we are now. We can lament where we were. I think March 13th was a sort of a seminal date for everybody. That was the pre-COVID-19 world. That is long gone, Scott. And we're now in the post-COVID-19 world, and we're going to enter a pre-vaccine economy. And until you have that vaccine, there's going to be a lot of vagaries and uncertainty about what people are going to do. Are they going to send their kids to school, go to sporting events and things like that? It's one of the main reasons why we need the contact tracing and the testing. But in that post-vaccine scenario, when we are back to normal, SkyBridge is going to be very well positioned to take advantage of that robust economy that's ahead of us.
Joe, we have something for Anthony?
Hey, Anthony, good to see you, pal.
Same here,
so
Joe.
As it relates to the high yield market, have you taken a look at the loan market? CLOs obviously were distressed coming into this crisis, had a modest recovery, really have not experienced the type of recovery, however, that we've witnessed in investment grade and high yield. I mean, that's a classic example of distressed. Would you go there?
So, we actually we have some exposure there in some of the better names that are sort of protected in the capital stack. You sort of have to get to 40 or 50% default rates before you crack into that CLO structure, Joe. But I would tell you, and, I think guys like David Tepper would probably agree with this, you've accelerated a lot of trends. And some of those trends are not great for certain tranches of commercial mortgage-backed securities and certain CLOs. And so I think it's incumbent upon us, again, to look at the world where it's going. I just want you to imagine what we're all doing from our homes and the productivity level that we have. James Gorman at Morgan Stanley on the air on CNBC talking about so much more productivity, perhaps doesn't need the scale of real estate that he has in terms of the Morgan Stanley footprint. So for me, when I'm looking into the future, I am worried about certain tranches. Now, you guys know liquidity has entered that space in the last couple of days. It's been induced by the Fed. But I would still say that there's going to be some accelerated trends that investors need to watch out for. We would be cautious in suburban office buildings, for example, obviously retail, suburban shopping malls, et cetera. They're going to have some difficulty here, Joe. It's unavoidable as we try to get lights back on in the economy.
Josh Brown?
Okay.
Hey, Anthony. Great to see you, my friend. It sounds like you're saying that past performance might be indicative of future results. You're talking about legendary investors, and they definitely are, the names that you're talking about, but persistence is very rare. And if you had bought into, for example, the best performing managers during the financial crisis, over the next 10 years, their performance was statistically awful, both on an absolute basis and relative to the market. So what are the pitfalls in saying, look how great these people have already done, I'm going to bet they're going to keep doing great? And how do you explain that to clients? Thank you.
Okay, look, it's a good question. It's a tough question. I would say to you that if you go back into I think we're setting up similarly to where we were in 2009 and 2010. And I don't know if I'm allowed to disclose the audited results of those managers. but those managers blended were up anywhere from 40 to 70% over that period of time. And so, I think certain areas of the market have great long-term intrinsic value, great long-term fundamentals. Certainly parts of the structured credit market where the cash flow's there, the default rates are not there. And as spreads start to tighten, Josh, you'll see that stuff go up a lot. And so for me, I went through a very, very detailed analytical analysis, CUSIP by CUSIP, with a lot of these guys, and looked at where I thought the recovery was going to look like, the magnitude of the stimulus. And, you're right. We have to look at past performance. And as you just said, it's not necessarily indicative of future results. But as a money manager and somebody that's been doing this for 31 years, 15 years since we founded SkyBridge with the same investment team, I would say to you that I like the odds there. I like the odds of their versatility, their skill set, the strength of the personnel around these people. And I think this is sort of a setup for 2009 and 10. And I would caution investors not to miss that. Don't sell in the middle of a crisis. Get yourself out on the sloppy bid side of the market. Try to think about who you can go to where you can enter managers like the ones I'm describing, enter them on the bid side as opposed to getting out of things on the bid side. And we both know, because we look at the markets all day, the spreads between the bid and offer are quite wide right now, particularly in distressed credit. So if we get some positive activity, look at what happened to the gaming stocks over the last couple of days. They announced their opening. They're short covering there. Fundamentals will improve. But I get your point. It's what makes the business so tough. Otherwise, everybody, Josh, would be flying around in private planes. It's a tough business, but we've been doing this now together for 15 years. I'm very optimistic about SkyBridge's future.
Anthony, we wish you well. You and your family. Stay healthy. We'll see you again soon.